And if you are on our Twitter account, you know I put in the delicious RenMac cucumber gin sparkle. So I brought it. I'm going to pour it. You guys keep talking, but I really brought one down here because, look, it's almost 3 o'clock here on the East Coast. It's a holiday weekend. The market's been closed for 2 hours. I think it's okay to have a cocktail.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
All right, welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It's Thursday, July 3rd, 2025. I'm Steve Duttonhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And Steve Pavlik is off this Thursday. I guess he's celebrating the July 4th holiday a little early, or he's reading a 1,000-page Big Beautiful Bill. Maybe that's what he's doing. Jeff, where are you?
Yeah, so I'm a bit of a contrarian, of course. So, it's a nice long holiday weekend. Usually I do this from the house. But today, since it's going into 4th of July, I decided to come in the office, mostly because the internet is down at my house, which is unbelievable. It's unbelievable. But I do have, I wanted to sport
that's
this.
A good one.
It's clearly on the wrong setting. It's going to pop my head off. But I have one of the original RenMac 4th of July hats. And so, I wanted to make sure that we brought that out. And if you are on our Twitter account, you know I put in the delicious RenMac cucumber gin sparkle. So I brought it. I'm going to pour it. You guys keep talking, but I really brought one down here because, look, it's almost 3 o'clock here on the East Coast. It's a holiday weekend. The market's been closed for 2 hours. I think it's okay to have a cocktail.
Well, that beats where I am. I'm outside Philadelphia. I have a glass of or a thing of water because it's hot as whatever here. A lacrosse tournament.
That looks terrible. Well, look at where Neil is. It's got to be even hotter there.
Well, you can't really tell based on my video frame, but I'm actually in Medellin, Colombia. The famous Pablo Escobar town.
That's it? That's all you're going to tell us?
And I'm here for my brother-in-law's wedding.
Because he's a fugitive?
Like I said, he's not a fugitive this week. No.
All right. Without further ado, it's Payroll Friday. Let's go.
Make sure to tell Trump to get him extra back to the United States.
What do you got for us, Neil? Payroll Friday or Payroll Thursday, I guess, this week.
Oh, just point of fact, I was on a flight as the jobs number was hitting, and I assumed that this airline, Avianca, would have Wi-Fi. They didn't. And I was just like, this is probably the first time, I don't know, maybe in 15 years where I wasn't plugged in some form for an 8:30 jobs number. So anyway, not every data point is going to go your way. And that was the case with this jobs number. I'll admit that. It's the most interesting thing to me was, basically the fact that the unemployment rate declined a tenth to 4.1%. I had thought that it might be going up because I was looking at continuing jobless claims and they've been going up. So if you take that at face value, it basically would imply then that, if you have higher continuing claims, but a decline in the level of unemployment, it means that the take-up rate has gone up. That's just if you just take the data at face value. So the data was better than I thought, to the extent that this puts at bay nonlinear risks with the labor market. It kind of quells any expectation for July. Not that we thought that was going to happen anyway. And it kind of raises the stakes for the data over the summer to kind of make or break what happens in September. Now, just because the data wasn't as bad as I had assumed doesn't mean that the data was good. Now, I think to me, there are a couple of concerning points. The first is simply that the work week fell and total hours worked over the last month basically flat. So if you have flat hours worked, you're talking about a very sluggish GDP growth environment, right? So that's sort of point number one. And point number two is that the sort of breadth of employment growth is very, very sluggish. Okay, you had less than 50%. I mean, the payroll diffusion index, that was under 50. Okay, so a lot of the growth is coming from things like education and health. You had a huge pop in state and local government employment. That's probably some kind of seasonality story, right? Like, so maybe schools closed earlier, and maybe that means that there were more people showing up in the payroll count. I don't know. I mean, but I have a tough time seeing how that lasts. So the breadth of the employment data is weak. And importantly, the cyclical areas of the employment growth are quite sluggish, right? Like, so manufacturing was down, mining was down. If you look at professional and business services, sort of traditional white collar employment, that wasn't particularly strong either. So, there's, just because the headline number was okay and unemployment fell doesn't mean that there aren't some concerns out there. And the last thing I would say is that, there is this view out there that because the labor force is declining, and it is, you had a huge decline in the number in sort of foreign-born labor force, right? Like, so to me, like, that's kind of like the political element of this. Labor force growth declined. A lot of that had to do with foreign-born workers leaving the workforce. But there's not really much evidence that that's tightening things up, okay? Because wage growth is still cooling off, right? So if you look at wage growth, it's still slowing. So when you take like the sum of jobs, work week, hourly earnings, that's slowed over the last several months. I think it was basically flat in June, and that's basically a proxy for nominal GDP, right? Like, so if the Fed funds rate's at 4.5% and nominal GDP looks like it's running a little bit weaker than that, then, that to me is a sign that the Fed is still passively tightening policy. Not every data point's going to line up exactly the way you want it, right? I mean, but the payroll number offsets that. It offsets the fact that ADP was weaker, the ISM employment components were weaker. You just have to kind of take these numbers as they come to you. But generally speaking, I still think the economy's on a cooling track. This data point kind of went the other way. But to me, the concerns are still there. You have very, very weak sort of hiring breadth. You have continued sluggishness in housing. You're seeing that again today with backup in rates weighing on home building stocks, for example. So, there's just too many things, in my opinion, that don't work with interest rates up this high. And that ultimately means still, in my view, that they'll have to come down. So I still think September's a reasonable base case.
So are we in a situation, Jeff, where good news for the economy is good news for the markets? I mean, we saw a little bit of a rally in the equities today. I don't know how that fits into your overall call about positioning and whatnot.
Yeah, look, I think there's a couple things. I think the markets are forward-looking and they see the Fed on the tape. Obviously, they're not on the tape as much as what they expected. And I do think that there was just this exodus that is left a lot of cash on the sidelines around some of these fears around tariffs, and that's improving now, right? And so you've got allocators, and you can see it in the data. You've got allocators who freaked out. They shouldn't, because they've got long-term horizons, and now they're using futures to gain exposure. So I think this is a sentiment picture. I think this is a positioning picture, and I think this is a seasonal picture. The one thing where I would agree with Neil in terms of what the market's saying is discretionary, which should be leading. I mean, we had cyclicals make new highs against defensives, so that's tech, that's industrials. And I was on a call with a client earlier today, and I mean, he said it so eloquently. This is really about a industrial type of leadership coming out of this low. It's not about consumption, right? A lot of times you'll cut rates, you get consumption, all that happens. And I thought that fit exactly with what we're seeing in the marketplace, which is, look, the discretionary stuff doesn't look that interesting to us. There are pockets. Hotels, as an example, look pretty good. But when you get right down to it, the cyclicality is embedded in kind of big things, right? The capex type of cycle, not the spending cycle. So I think all that ends up being part of what we're seeing. And so, to fit in with a more bullish narrative overall, I think you'd want to see the consumer discretionary names doing well, and they frankly aren't. But there's enough other things happening that keeps us bullish. And keep in mind, I mean, seasonality still works in July. We ran a study this week that just said, hey, if you have a 20% drawdown in the markets for the first half, does that kind of throw the seasonal textbook out the window? And in fact, it doesn't. It's very, very similar, albeit there's more variability than the 100 years of data that we usually work with. There have been 15 instances back to the late 1920s where you had a 20% drawdown in the first half. In each one of those, July is stronger, August is stronger, September is weaker, October is a little bit more of a mixed bag, and then you end up with decent strength into the end of the year. So I think that's still where we are. There's a few things that we want to keep an eye on. I do think, to Neil's point, that breaking the back of the bond market would be bad news. That'd be through 460 on our end. We're not seeing that yet, but I think those are all things that are worth watching. And by the way, this is delicious. This is unbelievable. I'm going right to the pool.
I was going to compliment you on that large discussion while drinking. That's pretty good. Well done.
And I got my Wingfoot glass from a good friend of mine who gave me a Wingfoot.
So are the cyclicals outperforming as well because, or at least defensive because of the dollar? Is that part of that play too?
I think there's something to that, but I think it's more than that. But I definitely think there's something to that, right? I mean, because you could at the same time say whatever the dollar influences, the yield influences negating that, right? So you get a little bit of a tug of war there. But yeah, I think there's something to that story as we go forward.
Right. You alluded to some of the ISM numbers. The global PMIs came out this week. They were soft, I think, earlier in the week, right?
Well, they were soft on net. I mean, I think by our work, about 40% were in expansion territory. So that's a little better than the month before. I mean, most of it's just swinging around with the U.S. and China. So the U.S. and China did better over the month. And so that kind of pushed up the global PMIs. But look, I mean, the survey data hasn't been as strong as, some of the hard data that we've seen, at least in the last month. I mean, we're talking about this on a payroll Thursday. And, if you look at ISM employment index, that was well below 50. The ISM manufacturing employment index was sluggish. ADP was negative. I mean, so some of the survey data, not ADP, the consumers, what consumers have been saying about the job market, that's generally been getting worse. And yet, here we are with the, talking about a very strong, a solid employment report relative to some of those expectations. So, that's going to be an important story, I think, over the summer, is how the survey kind of data, soft data, and the hard data reconcile. As I say, like looking ahead, from our seat, you're still in an environment where I think, the nominal policy rate is running above the rate of nominal growth. I mean, so that's passive tightening. So either you think the Fed's going to cut at some point later this year, or growth picks up. And I have a hard time seeing how growth picks up because nominal income was already slowing going into the sort of tariff announcements. Now the tariffs are likely to show up a little bit more over the summer. So that's going to weigh on real incomes, which should in turn weigh on real consumer spending. And in turn, that's going to reduce growth expectations, which should weigh on, private sector investment to some extent. So, and to the extent that firms don't pass on as much of the price shock to consumers, that'll be a margin squeeze, and they'll have to respond to that. So, I don't think that we're out of the woods. For now, I'm sticking to that view. If things are, to me at this point, the risk obviously to our call is that there's just this wave of enthusiasm that's coming back from the signing of the fiscal legislation that gets things moving up, back into the economy, get animal spirits going and so forth. And so basically that would kind of be consistent with the idea that the economy can handle rates up at this level. But I still remain very, very skeptical of that. I mean, again, housing isn't weak because of tariffs or anything else. Housing is weak because interest rates are too high. And auto loan rates, tariffs hurt autos, but auto loan rates have been very, very high for quite some time, and that was going to kind of hurt auto spending anyway. So, like I say, I mean, if you look at real consumer spending, over the first 5 months of this year, it hasn't actually been any great shakes. So, that's kind of where I'm at.
Jeff, how do you think about asset allocation, either here globally, whether it's fixed income, equities, commodities?
Well, if you look at real yields right now, you actually have some value in the bond market at 450 or so, less at 4%. But I think there's some value there compared to equities. It just depends on your duration. But what you do, and we always solve for Sharpe ratio, right? So we always are solving for volatility because that's important to kind of keep people in the game. And I think we're running, I can't remember off the top of my head, but it's basically an equal basket. We've taken cash down. We've got probably about a 40% equity allocation, 30% bond allocation, then about a 15% to commodities. I think that's where it is. You catch me off guard on that one, but it's in that zone. But we're in a zone where commodities do have some flavor to them, and I think if you look at, say, copper. Copper's on the cusp of breaking out. Platinum already broke out. Silver looks fantastic. Most of these are precious metals. Natural gas looks a lot better than crude. Obviously, we're not bullish on crude in the weakness there. So, we're kind of playing it. We solve for volatility and then work backwards, and that's where we're seeing the best opportunity as this balance between those equities and bonds there. But Steve, that's for paying customers. I don't know why you're asking me that on this free podcast, but we'll leave it at that.
Sorry, go to edit that one out.
Dang. Well, the other thing I would say just to Neil's point, right, which is you've got these elevated rates, and I think one thing to watch because they do look good to us are financials, right? And so we know historically that there's a pretty strong seasonal pull to financials here, particularly banks. Banks tend to do well, or the financial sector does well. July, August, and September, and then really starts to suffer in the fourth quarter. So I think those will be interesting to watch because to the extent that these rates can't handle, or the economy can't handle these rates, you'll start to see that relative performance in financials start to peel off. So far that hasn't happened, which I think is good news, but certainly that's one thing I would watch as kind of Neil's world, my world. If they're gonna meld, that's one of the things that I'd be paying attention to.
All right, mailbag.
Yeah, I would just say that, look, like I definitely think that, the markets are going, it's one of these things where I remember back in like late February, everyone thought I was a genius because the markets were kind of going, in line with our call. And then obviously
I didn't think you were a genius. I just thought you were above average.
Yeah. Well, and if you're batting over 300 in this business, you're doing okay. And anyone that tells you different is lying to you. And I threw this up on our LinkedIn. If you look at like just the performance of economic data surprises and the stock market, right? Like you had this big waterfall in the equity markets, and now you see economic data surprises generally come down, right? Like you've seen weaker production, weaker housing, weaker retail sales. And stocks have just continued to go up, after the Liberation Day situation, right? So now you're basically like you have this like little K almost, right, where stock prices are going up, and you can show the chart maybe for viewers, and surprises still generally on net have been negative. I think the simplest explanation to that is that the stock market thinks that trade tensions are the primary cause of whatever weakness we've seen, and now that that's over, we're kind of looking towards a better second half, right? So, the question is whether we're going to get that. And I'm skeptical still that we will because of the reasons that I've mentioned. So I do think that, the rubber is going to meet the road in the third quarter. And after that, we'll kind of see how the data stand and then reassess.
All right, let's get to the mailbag. Harry, are you there? There you are, Harry. What do you got for us this week? Reminder for everybody that's listening, if you want to submit your questions to us, and we use them, we'll send you a nice RenMac hat. Maybe one like this, maybe one like Jeff has, that red, white, and blue one. Where is that, Jeff? Get that back out there. There you go. It's fancy. We got all sorts of colors and combos.
It was cutting off the blood to my head, so I had to take it off. I got to resize it. My kids must have been wearing it.
All right, Harry.
That's better.
There you go. Give it a whirl. What do you got, Harry?
Okay, today we have the question come from John Belk. The question is, what other factors are responsible for the curve and PMIs possibly losing their predictive power? Thank you.
All right, so John Belk asking, typically leading indicators such as the yield curve and PMIs have indicated slowing growth in the post-COVID environment, but have not led to a recession to date. So what other factors are responsible for the curve and PMIs possibly losing their predictive power? Neil, I know you have a soft spot in your heart, as do I, for the PMIs, and I'll throw some data out there, but I'll let you go first.
I mean, the PMIs are a good kind of rough and ready indicator, but they're not a substitute for hard data. I don't think 300 purchasing managers really know anything more about the world than you do. So, I kind of just take it and, you put it into, I think it's useful, but I don't think I wouldn't base my entire call off of it. Why has it lost its predictive ability? I mean, it depends which PMI you're looking at. I mean, the ISM manufacturing, for example, obviously the economy is not as manufacturing sensitive, but, these numbers can move around a lot because of headlines, and that kind of can skew the signal they get. I mean, they're just more volatile in some respects than some of the hard data. So it's really about when you want to use them. I don't think, like I said, I don't think they're useless, but I never thought that they were particularly useful leading indicators to begin with. I mean, it's a kind of a tough question for me to answer. I guess I would say I don't have a good response to that because I've never been a big fan of the PMIs. I don't know what else to say.
Well, I'll jump in there. So, it's interesting. I got in the business in 1990, and when you looked at the curve in 1990, we've got all the data going back. And one of the things that we do, which I think is unique and it's really important, it gets underutilized in this business, is we use a rolling T-stat when we measure the efficacy of different data points. Partly because some things go in a favor and some things come out of favor, and so there's a bit of a hot hand effect. And look, in 1990, all you needed to really know was what the spread between 2s and 10s were if you're going to predict either the market or the economy or anything in between, really. And what's funny is when you come through and look at these things, the efficacy of the curve peaked exactly in 1990. So the curve to predict, I'm talking about the markets, right? So that's one thing that we need to differentiate. Not talking about the economy, I care about the markets, less so about the economy. So when it came to predicting the markets, it was actually great when I first got in the business, when I learned about it, and it's absolutely gone into a slide of irrelevance ever since then. So I think that's one thing that's really, really important to keep in mind, that the curve has actually been a lot less effective. The other is that PMIs, historically, if you look at this, the 6-month forward returns based on PMIs have a negative T-stat. I said that correctly. It's a negative 3.56 back to 1965. In other words, the worse the PMI, the better the forward return for equities. In fact, statistically significantly so. And I think that's, it just blows a hole in this whole cottage industry that PMIs are, the magic bullet that's out there. We actually will use it, but I'll use it contrarily. I will not use it as a confirming indicator. So I think that's just one thing to keep in mind, as we like to say, know the data, don't presume, know the data. Again, this isn't about predicting GDP, this is about predicting the S&P. As we look at it, we'd actually look at the PMIs as being more supportive here where they are than not. So it's actually, they're in the 30th percentile right now, which is about average returns to the S&P. But once we drop to the 20th or 40th percentile, or 10th percentile, I should say, good things tend to happen.
Great question. That was good. Neil, I know you got a wedding party to get to. What are we watching next week?
I'll be watching the employment, like the weekly employment claims. I think that's still going higher. I do think that some of the enthusiasm around the job market that we've seen in the last day is probably going to be short-lived. So to me, I think the employment numbers are paramount, and we'll be keeping a close eye on weekly and initial jobless claims.
And I guess we have, July 9th is the tariff deadline, right? And that's not, I know your wheelhouse, but I know Steve wanted to talk about that. He's not here. We'll talk about it next week. But that's, we've got 2 deals on the tape right now, Vietnam and the UK, I think. That's coming up next week.
Yes, I'm sure the Vietnamese are lining up at the gates to buy Ford F-150s.
Jeff, what are you watching next week?
Well, I'm going to continue to watch the internals. I am not freaking out on the internals like a lot of people are. We need the equal weight S&P to make a new high. It might have today. I don't have the data in front of me. Once the equal weight S&P makes a new high, all the internals will start to get better. 65-day highs will start to expand, which they already have. 52-week highs will start to expand. So that's what you really want to see. It's kind of the litmus test of how broad this is. I thought the punch in the nose that momentum took or beta took on Tuesday was actually a good thing. It was not money fleeing the market. It was money really kind of more broadly participating. So for those that are using breadth as a crutch, I don't think it's a crutch. I think you're barking up the wrong tree here. So I think the market's actually in pretty good shape. I would continue to watch this rotation that we think will happen. It hasn't happened in earnest yet, but coming out of beta for momentum, I think that's going to be the trade for the summer, and that's certainly how we're thinking about it. And of course we're going to have the RenMac drug test on Monday. So when Neil gets back, we'll make sure that everything's.
I'm actually not back on Monday, but I'll try my best to be on for the morning.
Sorry. We'll push that out a couple of days.
Well, that's good to know. So you'll have a recording for a Monday morning.
Remember, I am a product of the Reagan era say no to drugs era. So and it worked. So
of course. But nobody should be saying no to a cucumber gin sparkle. Let me just put that back.
Are you done?
This is so refreshing. It's unbelievable.
Are you done with it?
No, I'm not done with it, but it's I'm working on it.
We'll get there. Well, in any event, that's a wrap for us. Join us next week when we will be 1 week older, 1 week wiser. And don't forget to follow us on Twitter, YouTube channel, or you can reach out to renmacaccess.com for more information on how we can help you navigate these markets. Until next week, have a great 4th. I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
Take care, everybody.
Cheers.